Probability-based Forex trading by Vadim Leonidas. So, about me. My name is Vadim. I'm a Forex trader, born and raised in St. Petersburg, Russia. Moved to the US in 2001 at age 16. I started trading stocks at age 19, and my mentor was the biggest S&P 500 E-mini futures trader in the world. Full-time futures and Forex trader for years. I have managed 500 plus futures clients at some point. I started my own prop firm with 10 traders, 5 years of automated system development, 10 years of forecasting different markets, in total 13 years of trading and education experience. I sponsor several children in Tibet. I practice daily mindfulness meditation, and I love trading and teaching. Let's talk about market's nature. I believe these statements to be true, and you can ponder or test them later. But for now, just kind of take it in. I believe that market can only do 3 things at any given point. It can either go up, down, or stay sideways, not go anywhere. Markets will screw over as many participants as possible at any given period in time. If you're feeling pain, there's a lot of people are feeling pain as well. Anything and everything can happen at any point in time. I do not know what the market will do next. I simply don't. There's always a 50% chance of any one trade of working out. It's either going to go up or down. Markets move based on perceived value in anticipation of future gains. For every buyer, there's a seller, and for every loser, there's a winner on the other side of the trade. Markets move in predictable patterns which can be anticipated and taken advantage of. And that's what we try to do. Let's talk about trading and market myths, realities. Here's a myth. Trends happen on heavy volume. False. The reality is that markets trend on low or light volume. And you can test that for yourself later on tonight. Myth, doji or a hammer or whatever is a good candlestick pattern. Reality is there are no candlestick patterns on time-based charts. Prices are fractal in time scale, and there's almost always a contradictory pattern on other time frames in the same period of time. The myth is it can't go any higher or it can't go any lower. And the reality is, yes, it can and it will. Forex market moves purely for technical reasons. No, the big money moves currencies, and they don't look at the candlesticks or RSI indicators. Moving on, there are no they. If you trade with them, then they become you, and you will be them for other traders. You know, we always try to kind of, I call it responsibility shifting. Oh, they took out my stops, so they made the rally. Well, if you were trading with them, you would become they. So then other traders would be calling you them, and that's kind of cool. Let's see, trading process. I do the same thing every day. I always ask myself these 3 questions. What has the market done so far? What is it likely to do next? And how good of a job is it doing? So let me elaborate a little bit, because this is very important. I visually go through the chart. If I'm looking, let's say, at the 4-hour bar chart, I go through every ebb and flow, every turn, every trend, every range with my eyes or my cursor. And I'm really trying to feel what the participants of that market are feeling or have felt at the time and are feeling now. Because I want to be in their shoes, because I want to anticipate what they're going to do in the future or now, and also what other traders like me who are not in this pair, for example, or in this market are going to do. So I want to feel what they're feeling. And then I ask myself, what is it likely to do, or what is it trying to do? And I usually come up with a hypothesis, like, well, it's trying to, it's trending, for example, and it looks like it's making a pullback, and it's doing a pretty good job at making this pullback. So you're just observing what the market is doing. So then I create a profitable daily process for analyzing. Oh, so no, I'm sorry. This is a statement for you. I want you to create a profitable daily process for analyzing and trading the markets, and then adjust according to your results. So create your own routine process for trading in Forex. Let's talk about chance versus probability. This is kind of the theme of the presentation of the webinar. Chance is a layman's term for probability. You can always say that probability is a calculated chance. You can also say that probability is a calculated chance. What is the chance of this trend making a new high? About 50%. What is the probability? About 80%. So you see the difference. Probabilities are always calculated. There's some kind of statistic behind it. So in order to succeed in trading, we must start thinking in terms of probabilities, not simply taking a chance. And how come no one ever asks, what is the probability that on a perfect looking head and shoulders pattern at the top of the range or trend, it will form a right shoulder? Will it even break the neckline after it forms? What's the probability of that? Will it make a pullback to the neckline? Will it reject the neckline, or even if will it move away from neckline by the size of a shoulder or head? So all these things we need to know. And nobody really asks these questions or knows statistics on, yet people take these patterns without really knowing the statistics behind them. Moving on. If you are not trading with statistical advantage of calculated probabilities, you are most likely giving your money to traders who do. I probably have some of your money, but please don't ask me for it, though I can show you how to earn it back. When you place that order or push that buy at market button on your computer or phone, you must always ask yourself, what is the probability based on past live trading performance that this trade or pattern will work out? And if you can come up with a number, like 76%, for example, then you're basically gambling or taking a chance. And we know that a chance has a 50% probability of work, or 50% chance of working out. And yeah, basically you're gambling, and Las Vegas can be a lot more fun, trust me. And today I will show you how to answer the above question before you take your next trade and risk your hard-earned money. And that's what we're here for. Now let's talk about probability stacking. What is it? When you have several supporting tools or patterns indicating a certain trade direction and price, the probability increases drastically. For example, you are looking at a pullback in the trend to a 68.1 level, and it happens to be 68.2, I'm sorry, it's a typo. And it happens to be at around 0.0000 price, plus minus a couple of pips. And there's a fourth or higher trend line touch. There's a divergence on some oscillator, plus moving average, plus whatever tool you use. When all these things kind of stack together, you have a higher probability of a winning trade. That trade or pattern now has a high probability of working out. Track this, and you will start trading with probabilities. That is basically what every trader should do. It's time to think different. Have you ever looked at an upside down question mark? Kind of looks like a little person, doesn't it? Someone is taking the other side of your trade. What do they know that you don't? Why should you win versus them? What is the probability of this trade working out? How am I feeling right now? This is a life-changing question. And if you guys in the room, you probably know this. Somebody starts panicking. I always ask, okay, dude, how are you feeling right now? Something I learned from my mentor. It's very important. And just outside of trading, to ask yourself on a daily basis, how am I feeling right now? Really try to connect with yourself. And this question mark on the right, this is you. And it is you who has to ask yourself these questions every day. What is the probability of this trade working out? How am I feeling right now? What do the other traders know that I don't? Also, what's important to know is, what do the traders who are sitting on the sidelines know that I don't know, right? Because those are the guys who are going to affect the market as well. Well, let's talk about trade distribution. This is a bell curve. Everybody knows it. So most of your trades are going to be small wins and small losses and break-even trades. So this zero line right here, so these are all your trades. We're looking at scale. This is money or pips, whatever, and this is number of trades. So most of your trades are going to be here, okay, in the middle. A lot of small wins, a lot of small losses, a lot of break-even trades. You're going to have a lot of trades that are big winners, okay? They're going to be located right here, all right? 100 pips, 500 pips, 1,000 pips. And then there's going to be trades that are on this end tail of the bell curve. And what we're trying to do really is to cut that tail off, say at this line. That's your stop loss, right? So letting the profits run, okay, and cutting your losses short. You never want to have trades in the tail end of this bell curve, okay? You must have a lot of large winners and very few large losses, okay? Let's keep going. There are pattern differences. Knowing when to stay away from the market is just as important. So, for example, in this picture here, this is a range trading. It's actually a correction of a larger move down, and this is not a trend. This is not a trend, even though you can make an argument that there's higher highs and lower and higher lows, but this is not a trend. This is a clean or a clear trend. So we want to know the differences between charts and patterns that we trade. Very important. Which leads us to Leonidas Method. Basically, it's years in development, always evolving with changing markets. Uses everything I have learned from all the markets that I have traded. I know exact probabilities for each pattern trade that I take. I use strict money management rules, a very high win rate, high risk-reward ratio. Most trades are to within 1 or 2 pips of a turn. Uses only limit orders, never at market. Less stress, more profits. And it trades all 3 trading environments: trend trading, counter trend trading, and range trading. Here we see an example of AED USD. The call is to set a stop limit. To set a buy limit order at 74.763. These are 4-hour charts. Wait for a fill. Goes against us by about 2 or 3 pips, and moves up about 150 pips to the take profit. So let's look at trade types. Currently trade 6 patterns. I track performance of each type and class. I keep strict rules for each trade. Some trade types never lost a trade within a good trade sample size. For example, type 3A. I have taken 28 trades on it, and I have never lost on that pattern yet. Some trade types, let's see, all trades are tracked in real time, no backtesting, and that's something important to me. Having a lot of experience in backtesting and system optimization and coding, you don't want to backtest anything. Whatever idea you have has to be tracked real time, because human brain is developed for pattern recognition, and later I will tell you how it's not created to actually trade in the markets, but we're very good at recognizing patterns. These statistics represent only live trading, and my favorites are 1A, 1B, 3A, 4A. Those are the ones I try to focus on the most. And I still take all the others because I need to get at least 20 data points for a statistic to be valid. So I wait, for example, 5A. I'm looking for another 7 or 8 trades before I decide that I don't want to take this pattern anymore, which happens to be range trading. Very important to know. And composite indexes, it's my little secret, it's my secret edge. It uses proprietary formula to calculate each currency movement and strength. All of my trades go through composite index confirmation process. I never take trades against my composites. Sometimes I do. You cannot find these anywhere. Even DXY or dollar index, for example, if we're talking USD, are inferior since they do not account for all the major currencies, and they're weighted indexes. It's just somebody's idea. They don't represent reality. Here's an example of British Pound index on the daily chart. Basically, we have this breakout of this triangle, let's say, and it's going lower. And if you do not have this chart, you might be looking at all the British Pound charts, trying to kind of figure out where the British Pound is going. And really, the question is, would you like to buy any British Pound pairs right now? And the answer is no, just based on this chart alone. So very simple it's very easy for me to look at at the currency itself without looking at all the charts. Here's an example of Euro index chart. Did you know Euro was doing this? You cannot find this on any Euro pair chart, but there's the strong resistance on Euro. That's why we've been shorting Euro CAD. Let's see, moving on. Of course, this formula or these indexes work on any time frame, 4 hour, 1 minute, whatever. Here's the CAD picture that I posted in the chat room, indicating that we're going to come down, test all these lows, and move higher. And that's what CAD did, before and after type of thing. Okay, keep going. So index moves equal great trades. For example, recent USD drop, which was predicted by this breakout and double top to the resistance level, and then a drop on FOMC news, plus the previously saw CAD trade, or forecast, I should say. Combining these two together, USD going down, CAD going up, we short USD CAD to the, well, let me just show you. This is the USD CAD, red flag indicating news. That was FOMC. Nevertheless, great entry, and first TP is taken, and the trade actually continued lower to 1300 level. Moving on. 3 essential trading skills: trade management, risk management, money management. Let's talk about each one in particular. Trade management. For me personally, I scale out of positions as they become profitable. I implement 3 take profits and 3 stop losses. I manage each trade individually and move these orders to protect my gains. My software also moves my stops into profit, etc. while I sleep. So, for example, let me just mute everybody. For example, this trade here, you can see I have 3 stop losses and 3 take profits. And as the market moving in my direction, I'm going to move these stop losses. And as I take my profit, I also move my stop to below the entry to protect my profits. Okay, so that was trade management. Risk management. You must not, or for me at least, you must not trade or risk more than 2 to 3% of the account equity on any one trade. No more than 10% total account exposure, i.e. 5 open trades at 2% risk, or 3 trades at 3% risk. So in total, if you're open positions, no more than 10% of your account total. If you must open more trades, you have to account for that and take smaller lots, risk less money. And but trades that are in profit and stop loss is moved to break even, those do not count. Since you cannot lose on them, they are not part of your 10% exposure rule. And then there is a concept of personal money management, okay, which means that see, the 2 to 3% applies to your total account equity. But if you're only willing to lose 30% of your account, then your risk must be between 0.5 and 1% on each trade. And here's why. The 2% rule, you can still lose your entire account, okay? So, but you also have to ask yourself, if I go into a 30% drawdown on my equity, am I going to be okay? You know, am I going to sleep at night? Am I going to have, you know, health issues or mental issues if I have a 30% drawdown? If the answer is yes, then your 30%, let's say you have a $100,000 account, so $30,000 is now your new equity, okay? Because that's the most amount of money that you're willing or are comfortable with losing. So now that 2 to 3% rule is applied to the $20,000. Or I'm sorry, the $30,000. Okay, so that's what's called personal money management. Moving on. Furthermore, risk management. You want to use a position size calculator. You know, each pair will give you a different lot size, so pay attention to that. You must never risk more than your predetermined amount per trade. For example, if your rule says 2.5% per trade or 3% per trade, and somehow you ended up with a 4% exposure on that trade idea, that's a major. I mean, in my prop firm, you kick out that trader. He's gone. He broke a rule. He broke a cardinal rule of risk management. That is the most important thing, to never break your risk management rules and risk very little per trade. So the less you risk, the better. You may not grow as quickly, but it will be steady and smooth sailing, and you will be in this business for years to come. If you're risking, 10, 15, 20% of your account per trade, man, I mean, it's like 3 trades and you're out. If you draw down your account by 50%, let's say you take 5 losers at 10% clip, 10% rate. Now, let's say you are 50% drawdown. So now you have to double your account to get back to where you started. Okay? There's not a lot of money managers in the world who can double their account, in a year. So this is a simple position size calculator. You can find it on MyFX book and other websites. Basically, you just put in your account size, how much you want to lose in percent per trade, and how many pips is your predetermined stop loss for that trade, for example. You pick your currency, and it will give you your lot size. And you will see that different pairs will have different lot sizes. So you can either average it out, or you can be very specific and really go through this process every time. And over time, you will learn, how much to risk on each. Mind management, one of my favorites. Basically, you can take a profitable trade and lose money. And this has got to do with psychology only, for the most part, outside of, crazy news and brokers. Humans are not designed for trading, basically. We're just not. The fight or flight response kicks in as soon as our money is on the line. And once the adrenaline is rushing and all these other chemicals, you cannot see anything. You're literally blinded by chemicals. It's a chemical reaction, and but there's some things we can do about it, and I'll tell you. And not only we're not designed to trade, we're also ill-prepared to trade. We don't have a mind training skills to participate in trading. So that's why most people lose money, really. Outside of not knowing what they're doing technically. Now, money and resources, it's a very emotional thing. So you're going to have that biological reaction. And another thing is very important. We get pleasure from random rewards. And that's why markets also attract a lot of, risk-seeking people, because when you randomly press a button, right, thinking that, oh no, there's something there, right, and you make money, wow, that feels great, right? But it's bad. It's really bad. Random rewards in the market are really bad. So trading should be boring, calculated. We're here to, make good trades, not to. This is not Las Vegas. And like I said, markets are ideal for thrill seekers. Everybody knows this. You must train your brain to handle equity swings and the apparent games the markets play with people. And we'll talk about brain trading for trading soon. You must become aware of your thoughts and feelings and not suppress them. And I'm going to give you a little exercise here in a second to show you. You simply have to become aware of your thoughts and feelings. And on the other scale, feeling unwanted or these bad emotions does not precede a losing trade. It does not predict, a losing trade. So you have to, there's a difference between an emotional response to an analysis or a trade, and then there is a gut feeling that comes with experience. So there's a difference between those two. So let's play a little game. I want you to not think about pink elephant. As hard as you can, for as long as you can right now, do not think about pink elephant. I want you to suppress the thoughts about this big, giant pink elephant. Try it right now. Don't think about pink elephant. I can't even do it. Really, stop thinking or imagining it. You cannot take it out of your head. Whatever you're focusing on doing or not doing, that is what the mind will focus on. So the same with feelings or emotions or thoughts while you're trading. Trying to suppress it will actually make it bigger, and it will affect your trading. So think about the pink elephant next time you, trying to not feel in the market. Stop trying to suppress your emotions, feelings, or thoughts while trading. Just stop it. Instead, recognize them, label them, observe them. Say to yourself, I am now aware that my mind is thinking about blank or feeling blank such way. I am now aware. So you're putting this distance between your thought or feeling and you're labeling it. All right, you're weakening it. It's not having that effect on you. You're simply noticing it. You're being mindful about it. Excuse me. Ask yourself throughout the day when you are trading, how am I feeling right now? This is a very important question, and I mentioned it before. How am I feeling right now is such a powerful question because there's a few things that will bring you in the moment, okay? And this question is one of them. How am I feeling right now? Okay, it makes you connected with yourself, with your feelings, and it brings you into the present moment. All right, so that question is very important, especially in trading. And wait for your brain to give you an answer. If nothing comes, if the answer doesn't come, then you're dead. Okay, because if you're a human and you don't have any feelings, you're and don't mind my username, Vadim the Machine. But seriously, ask yourself and wait for the answer. Okay, the answer will come. All right, and it's okay to trade with feelings. You're a human. Just notice them. It's all you have to do. Just notice them. So I want you to start practicing daily mindfulness. Okay. And I'll talk about what daily mindfulness is. Also, mindfulness meditation. You should learn about that for sure. This is such an important edge in trading, just the practice of meditation. It's secular, it's science-based, and every trader that I have dealt with who is successful on a high level, they meditate. No question about it. They taught me how to meditate. No multitasking. Switching your brain from task to task is, I mean, there is no multitasking. You can only do one thing at a time, but your brain can be preoccupied with other things, so that's why mindfulness comes into play here. When you are eating, know that you're eating. When you are talking to someone, be there for them in the present moment. When you're trading, know that you're trading. When you're drinking a sip of water, know that you're drinking water. Okay. Most people think about what they're going to do next while doing something right now. When are you going to live? Okay, so you only live now. Let's say you're eating, you're thinking about some trade or somebody to text or to check your Instagram while you're eating. So you're not living per se because you're in two places at the same time. And basically notice that you're noticing. All right. So I'm eating my food, and I'm noticing that I'm eating, and I'm also noticing that I'm noticing. How am I feeling right now? I'm feeling great. You see. Let's talk about biases and fear. Confirmation bias. Neglecting warning signs because you want to be right. Confirmation bias is a very important concept. Every trader is prone to it, including myself. When we are in the trade and it starts ticking against us, we naturally look for signs to reassure ourselves that the trade is still valid. But this is why in the trading room I get a lot of questions. Hey, is this trade still good? Yeah, it is. Usually I don't even look at it because it's like we get worried and then we look for either signs of trouble, but if we want to be right, we're like, well, this indicator still, especially if we're like in a loss. Okay, so like if the trade is in a drawdown, for example, then we're really looking for confirmation. That's when confirmation bias really kicks in. When we're in a profit and it starts pulling back, we have this fear, right? Fear of losing what we have. Right? So these are all natural things, and they can all be managed. Right? So hindsight bias, I knew it all along. I was right. So you're looking at charts, you're like, okay, well, this is probably going to go here and there. And then you come back a few days later, and you're like, oh, man, I was right. I'm a genius. So this is a hindsight bias. Basically, things in the past, they'll look. But at the time, at the time when you were making the analysis, you weren't that sure, right? Only a couple of days later, when the analysis became correct, you tell yourself, oh my God, I was right, but you didn't have that feeling at the time, right? So we forget really quickly how we felt at the time, right? Because the new feeling of, oh my God, I was right, is so powerful, right? It's so strong that it overwhelms, it basically deletes it from your brain of how you felt at the time of the analysis, okay? Recency effect, basically the market is doing this, so it will continue to do so. It's very important to know this and also recognize that markets go through cycles of range trading, range trading, trend trading, cycling up and down. Just it's all cyclical. So if something's been happening for a while, it does not mean that it will continue to do that. We have to be aware of that. Okay, that's why we always try to adjust to the changing environments. And so fear of losing out, right? Again, we're up 200 pips. Market starts to pull back. Oh my God, the panic, right? Comes down. We're in profit. It moves up. And now we are scared, naturally. We don't want to lose what we've had. We also fear of losing a trade, right? Losing a profitable trade, missing out on the. I'm sorry, this was supposed to say fear of missing out, not losing out. Fear of missing out. You see a setup, and you naturally have this fear of, man, if I don't take it, I'm gonna miss out on a good trade. Okay, so that's something we have to be aware of. So basically, fear of a loss, right? Not taking action, not taking a trade, and fear of losing out. Those are two extremes. So one is, you just take every trade that comes your way because you don't want to miss on any profits. And the other extreme is you don't take any trades because you don't want to lose any money, right? So those are two extremes. We want to avoid the extremes. And probability neglect. Basically, again, what we've been talking about in this webinar, you don't know what the probability of this trade working out is based on statistics. So keeping good records, keeping good stats of your trading, of your patterns, is very important because to avoid the probability neglect. Otherwise, you are gambling. So basically, my advice is to start meditating daily, read books on trading psychology, drink a lot of water, never trade with low blood sugar. You will make mistakes. Your trading requires a lot of brain power, and brain runs on glucose. If you wake up in the morning and you start looking at charts and you start making decisions, and your blood sugar is at 80, you're going to make bad decisions. Also at night, when you're up you've been in front of the monitors for 6 hours, you haven't eaten anything, your blood sugar is low, you're going to make mistakes. And you're going to gamble more on blood sugar, on low blood sugar. And before you click that button, ask yourself, what is the probability of this trade working out? You always have to ask yourself this question. Always, every trade. And I want you to just relax, breathe, think positively, and you will attract an outcome to yourself. So be careful how you talk to yourself, what words you use, how you talk to yourself, what you're thinking, okay? Bring positivity in your life, and positivity will be in your life, okay? And let's do a quick Q&A session. I want you to type the question in the chat box, and I will answer. You can also email me, and I will show you the contact information at the end of the webinar after the Q&A session. So real quick, you should be able to see a chat box somewhere, like here, and you can type in your question or questions, and I will scroll through them and pick easy ones. No, I'm kidding. Okay, the question is the purpose of the 3 take profits to help alleviate some of the fear of missing out? Okay, you're kind of on the right track. It's actually not the fear of missing out. It's a fear of losing what we have. So fear of missing out is actually taking every trade that comes your way. But no, there's several reasons take profits. Well, I usually post 2 to 3 targets, and it's very important psychologically to take profits and move your stop loss to break even, so you cannot lose on the trade and you already have some profit. So I deal in thirds. I take 1/3 here, 1/3 there, 1/3 there. All right. So for example, 50 pips, 100 pips, 250 pips. Okay. Let's see. Preston, do the multiple stop losses based on the 3 take profits points? If not, what do we do with stop loss after we put in the break even? So your stop losses, you move your stop losses to break even. I'm not really sure what you're asking. Oh, how do we know where to push stop loss up? Oh, oh, I see. Okay, so you're asking how far does the market, has the market go before you put a break even? Okay, so you can create a rule for yourself. Let's say if your first take profit is at 50 pips, let's say 1/3, then you can tell yourself, okay, so I'm going to take 50 pip profit. I'm going to have two lots left, right? So I'm going to put 1 lot at break even plus a couple of pips to account for, spread slippage. And so you can have a rule like that, and then you can have the 3rd lot linger somewhere over there to, give yourself some room. So the index charts are, you can ask me in the room about, I can send you the screenshots of the index charts. Otherwise, it's a proprietary formula, and it's not available anywhere except from me. Can we mirror your trades? Yes, I mean, you can take my trades in the trading room, and you can contact me for details after the presentation. You said once the pair is deep in profit, do we just leave sell stop loss at break even, or does it follow the price? Okay, yeah, good question. So if you've seen any of my videos, you will see that I move my stop loss with on the remaining stop losses. I move them with the market at key turns, and I move them by a few pips above or below the pivots. Okay. Let's see. Andrea just contact me. During a downtrend, what helps you confirm that the trend has stopped and will reverse instead of just pulling back? Okay, yeah, that's a good question. It really depends on the chart. I mean, I would have to look. I look at, my indexes. I want to see, is one of the currencies hitting support resistance? If it is, okay, then let's say one currency is still trending, right, and the other one is hitting support, right? It is more likely now that the pair will reverse rather than if both currencies are trending, right? One's going up, the other one's going down. There's no support or resistance for either of them in sight. Then, I mean, that counter trend is so risky, because you have nothing supporting it. All right, both currencies are going, opposite way, so the pair is trending hard. That's how you know. I mean, that's how I look at it. And then you can also look at the pair. The pair itself will have, okay, I mean, if it's not hitting support or resistance, then the trend is probably likely to continue. What are the pairs that have given you the most pips? Well, if you want to talk about in terms of pips, then I would have to say all the British pound pairs, naturally. Rafi, my man, if a trade goes 50 pips in our way, then hit stop loss on break even. Do you re-enter again? Okay, that's great. Actually, this question is really good because it also covers the other questions on, if we miss a trade by a pip or two. So for me, and I'm still, developing this particular rule, but it seems that if I miss a trade by, say, a pip or two, and it moves by 40 or 50 pips, like Euro AUD today, okay, we miss it by 1 pip, and then I think it moved 40 or 50 pips on us. I usually just cancel that trade and I let it go, and that's the pattern number 7 that I track. How often does it come back to get us a fill and then win, all right, after, X amount of pips? So that's on my thing. You'll see the pattern number 7. That's the big secret, right? That's the pattern. Yeah. So, but basically, if it goes 50 pips and then hits stop loss on break even, we don't. If you're already in the trade, for me, I usually don't. I'm just like, okay, I made 50 pips, on at least a third of my position, and then I broke even on the rest, or I lost a little bit. So now I'm still in profit. It's still a great trade. Move on, because if we get filled and then it moves 50 pips on us in our direction, right, and then it comes all the way back, well, that's a 100 pip move in my mind, right? Because we sold, but then somebody else bought, right? So I don't like to re-enter, Let me see. Any more questions? And we're gonna, we have 7 more minutes, and it will be perfect, if we can do this under an hour, so we don't bore anybody to death. Fibonacci. A lot of times when I'm Fibonacci, only when I'm uncertain. If I'm forcing a trade, if I'm looking for, the confirmation bias, but not, confirmation bias is usually when you're already in the trade, but prior to trade, I sometimes would look at different things just to kind of feel better about it, I would say, like, well, let me look at the fib, but actually, and some people, sometimes I do like Skype sessions, and I can, you can see if you're hitting a a Fibonacci level just visually with your eyes. We're very good at it. You can see where 50% is. You can see where 62% is. You can see where 38% is. It's not rocket science, really. It's just a pullback. If you place a trade with 3 stop losses and 3 take profits, and the trade moves against you, hits the first stop loss, do you manually close the other trades? Okay, so no, because your stop, if you have 3 stop losses, right? The average, let's say you have one at 50 pips, the other one at 75, and the third one at 100, right? So your average is 75. So you're basically risking 75 pips on that trade, okay? So you don't close out the trade on the first stop loss. You wait for all of them to get stopped, okay? And there's 2 reasons for it. You're following your plan, and second is even if you get stopped out twice on the 50 and the 75, for example, there's a chance, still that it will reverse before it hits the 100 stop loss, for example, and go into profit, and you might be able to actually break even on an entire trade versus losing, 75 pips. How do you identify main pivot points or areas to place moving stop loss trailing? Okay, so how to do the trailing stop loss? If I'm there watching it and actively trading it, like in a lot of my videos, I basically move it to obvious zones. I move it above or below the pullback pivots, right? So if we're in the trend and I'm up, 100 pips or whatever, so and let's say it's dropping, right? So it pulls back up a little bit, let's say 20 pips. I'm literally just waiting for it to make that high. So as soon as it starts going lower after the pullback, I will move my stop there, okay, just above that pivot, all right? But for example, like UCAD overnight, like last night, it was dropping, hard, and then it made like this little turn up, and then I was just kind of watching it. It hit one of my take profits, and then I was just waiting for that. I was waiting for it to stop pulling back, basically, and then place a stop there. Yep. Well, no, any more questions, guys? I'd be glad to answer. Anything on psychology? We're all technical, I think psychology is so important. Not one psychological question yet. Okay, I guess no more questions. Okay, what is the biggest obstacles to obtaining a trader psychology? Okay, so the biggest, it's a very good question. All right, what is the biggest obstacle to obtaining a trader's mindset? May I rephrase the question? So it starts with the, how we talk, right, to ourselves. So the word obstacle, right? We want to kind of eliminate words like that. We want to assume that we are already great traders and psychologically ready, right? So you can ask yourself or me, how can I better myself? How can I become a better trader? How can I manage my feelings and emotions better? I'm already doing a good job. How can I do it better? All right, so that would be a good question to ask. So we start there with how we talk to ourselves, like NLP, right? Neuro-linguistic programming. Very important in trading. And basically, like I said, start meditating, mindfulness meditation, being aware of what you're doing. Every time you place a trade, know that you're placing a trade. Literally observe yourself clicking that button. I want you to start reading books on trading psychology, how the mind works, how it's related to markets and trading, how the human brain is not designed for trading, how to get an edge psychologically, how meditation helps with trading and stress reduction, and asking yourself the question of, always checking with yourself, how am I feeling right now? How am I feeling? So those are all psychological issues. Just understanding to your monkey brain, how our primitive brains, basically, they want us to get that, reward, right? Like, oh, I made, 5 pips. So it's going to seek that, it's going to seek that pleasurable feeling, right? That reward. So we have to be aware of that. So I want you. That's why the mindfulness is so powerful in trading. It's like, what is trading psychology? To me, it's a misnomer, because basically it comes down to being mindful of what you're doing. And when you are mindful of your actions, thoughts, and feelings, it will not affect you. You will still feel and react, maybe even to trading, news, and whatever, drawdowns and wins. But it will lessen its effect on your trading overall. Do you consider going to the gym or any physical activity as a must? Yes, I should have included that. Thank you. I literally finished the presentation 5 minutes before the start. So let's see. Yes, I go to the gym about 5 times a week. And I think that it's very important to have good blood circulation, muscle tone, low body fat, high metabolism, hydration, good cardiovascular system. So many benefits in physical exercise. You can also be swole like Svein. You guys know Svein. He's a bodybuilder and a trader. And I run every morning. I just do 1 mile, and then I do like a sprint at the end, a 100-meter sprint. I've been sprinting more, actually. And oh, there's Svein right there. Svein, the bodybuilder. That's my man. All right. Let me know if you guys have any more questions. I'm here for you. I got this new bottle. It looks like stainless steel, but it's also a thermos, I think, and it's 1 liter or more. I think it's 36 ounces. It's the best thing I've ever bought. All those plastic bottles, even like sports plastic bottles, they just make your water warm after like an hour, right? This thing is amazing. Just I mean, I drink like a gallon of water a day, but so 4 of these, but it will stay cool for hours, Hey, Keanu, yeah, you're welcome, man. I'm gonna probably start making another presentation right after this one. Probably based on your questions, I can kind of see where the next presentation needs to cover, where it needs to be. And let me know, guys, if you want like a PDF version of this presentation after I haven't even proofread it yet. I gotta go through. There were a couple of typos, but yeah, I can definitely send you a PDF. You can DM me on Instagram or in the Slack app. Okay. All right. I think no more questions there, unless there's one more question, and then we're going to wrap it up. Do you have any points? Do you have any points on where the mindset actually begins to be better regarding trading, maybe without being able to see it yourself? Points on where the mindset actually begins. Svein, what do you mean by where mindset actually begins to be better? Like, are you talking about like a tipping point? Like, how do you know when you made progress psychologically? Is that what you mean? Okay, I see. It's a very good question. You have memory, right? And that is very good for analyzing your past performance psychologically as well. So next time you have a next time you make a mistake, or you have a loss, or there is an unexpected event in the markets, or something else happens like that. Let's say before you used to go kind of crazy, right? Maybe you would have like a what they call psychological breakdown, right? Even for 5 minutes, even for 30 seconds, right? You would be, maybe you were sweating, right? Maybe you just forgot, you literally neglected your whole life because of this one trade, right? So and now, for example, right, a month later after mindfulness training and just meditation and working on yourself and reading books and working out and doing all these things and staying positive and positive talking. Now when something happens, you say to yourself, okay, this just happened, and how am I feeling right now? Checking with yourself, right? Oh, okay, well, I'm feeling annoyed that this happened. Okay, annoyed. How else am I feeling? I'm feeling that everything's going to be okay. That I'm still alive. That I have family. I have friends. I have my limbs. I'm breathing. Life is good. Okay. How else are you feeling? Well, I'm feeling like I'm getting better at this. I feel like I'm not going to make this mistake again, and if I do, it's okay. I'm going to forgive myself in the future. So let's say you make a mistake now, and immediately after you make a mistake, I want you to forgive yourself. But you don't even have to forgive yourself now, all right? You can forgive yourself 5 years from now. You can ask yourself, okay, will this matter 5 years from now? Right? The answer is usually no. Right? So you can ask yourself, can I forgive myself now? Okay. What is the worst thing that can happen if I forgive myself now for this mistake? Okay. So those are the questions you can ask yourself. Also in your relationships. For example, if you have a girlfriend, and let's say she does something or you do something, let's say you guys have a fight. Well, instead of holding a grudge, you can say, listen, honey, how am I feeling right now? I'm mad at you right now, but I'm forgiving you, and I'm forgiving you, next month. So a month from now, I'm going to forgive you, but I'm telling you now, because I don't want to forgive you now, because it's going to look like I'm losing something, right? But a month from now, I'm going to forgive you. So when you make peace with the fact that eventually you're going to forgive this person, you can also do it now, okay? So when you make a mistake in the market, you can forgive yourself, all right? Start breathing, take a break, go for a walk, come back, look at your journal, write down some thoughts, look at your statistics, take screenshots of your mistakes, of your losers, put them in a spreadsheet, all right, go over them every weekend, and then delete them. You don't need to keep them. If you learn a mistake, also learn how not to repeat it. You're welcome, Andrea. Yes, thank you very much. So, Svein, was that a good answer? All right, good. Okay, good. Yeah, we're getting somewhere. All right, guys. Well, this was fun. Hopefully more to come. This webinar was being recorded, and I will have to upload it somewhere for other people to see it. And I will also post a PDF of this presentation as soon as I edit it a little bit. Because of my OCD, I cannot have typos out there. So thank you very much, guys. It is a pleasure having you here and knowing you guys. And I'm very grateful to have you guys here tonight. Thank you, Rafi. Rafi stayed up all night. It's 5 a.m. his time. Great. Thank you, Ricky. Yes, thank you. Okay, good night, Rafi. You deserve some rest. All right. See you guys. Bye-bye. Love you all. Bye-bye.